In this video, we'll talk about accrued expenses, why expenses are accrued, and how accountants record them in the general journal. Imagine this, you want to buy a small retail business and you're looking at the income statement for two potential companies, and you're a little surprised by the big difference in expenses between, let's call them company A and company B. Even though the revenue is $250,000 for each company. Company A has cost of goods sold of $100,000 and expenses of $65,400 for a profit of $84,600. Company B has cost of goods sold of $75,000 and other expenses of $57,000 for a profit of $118,000. Company B seems to be a better business to buy, but you have an uneasy feeling about the expenses of Company B. So you ask for more details and receive a quarterly comparative financial statement from both companies. You quickly notice that Company B has some unusual expense trends in the fourth quarter of the year. And when you ask about it, Company B states that they only record the expenses when they pay the invoices. The owner says, we just received 90-day payment terms from our supplier for our cost of goods sold, so we won't pay the invoices until February. Also, our landlord normally bills us for the utility expenses at the end of the quarter, but this time we did not receive the bill until January, so we'll include these utility expenses in our financial statement for January. In addition, we're now buying from a new store and office supply vendor. We have a credit line and we won't pay these invoices until February. You quickly realize that Company B's financial statements do not include accrued expenses, expenses that the business has already incurred but has not yet paid. And you begin to look at Company B's financial statement in a completely different light. So accuracy of the financial statement is a good reason for accruing expenses. So let's explore all the reasons for accruing expenses. There are four good reasons for why accountants record accrued expenses. First, accrued expenses ensure compliance with generally accepted accounting principles. In addition, the matching principle in accounting is a fundamental concept that requires expenses to be recorded in the same period as the revenues they help generate, regardless of when the actual cash is paid. This principle ensures that a company's financial statements, particularly the income statement, accurately reflect the profitability of a business during a specific period. Businesses also have to plan for the future by preparing budgets and forecasts, and accrued expenses help to accurately project expenses for future time periods. There you have it. Compliance with GAAP, matching expenses with the revenue they generate, accurate and complete financial statements, and financial planning are the four good reasons for why accountants accrue expenses. Next, let's talk about how the process of accruing expenses works. First, the accounting team should be very proactive in identifying expenses that have been incurred but haven't yet been recorded. The accounting team should send an email before the end of the month to department heads to ask if they sign new contracts, know about new expenses, changes to contracts, new equipment, rental agreement changes, etc. Auditors will ask you during the audit about how you verify the completeness of the invoices, and this monthly email is your proof that you checked with those authorized individuals about expenses that need to be accrued for. After the end of the month, additional invoices for the prior month will arrive. These invoices will still have to be recorded for the prior month. Hopefully, the business receives invoices electronically, so the accountants don't have to wait for the postal service. Many companies wait for 3 to 5 days to receive those invoices. Then another way accountants find unrecorded expenses is through financial statement analysis, which involves looking through the income statements for the prior month and comparing them to the current month. Is there an expense account that looks much higher in prior month than in the current month? In that case, you'd look at the details of the account for the prior month to see if there are recurring expenses in prior month, but there aren't the same expenses in the current month. For instance, there is a contractor who does software development each month for the company. The amount differs from month to month, from $1,000 to $1,500, but in the current month of August, there is no amount. The first step would be to check whether the contractor is still doing work for the company, and the next would be to check where the invoice is. If there is a delay in receiving the invoice, you would estimate the amount based on prior month. Our textbook focuses only on accrued salaries, payroll taxes, and interest on notes payable. In practice, there are many examples for accrued expenses: commissions to salespeople, accounting or legal fees, utilities, phone bills, even a lawsuit with a high probability of success if the amount of the settlement can be estimated. In this class, we're covering the basics, but subsequent accounting classes will focus on how to determine if you have to accrue for an expense. Sometimes it is a complex decision. For instance, many companies get sued by customers and other companies or individuals, and the company may not be able to determine right away if the lawsuit is valid. Companies spend a lot of time to determine if a liability exists with a high degree of likelihood, if the amount can be estimated, and when the accrued expenses can be recorded. Let's talk about a few common accrued expenses, starting with accrued salaries. Payroll checks are often issued on the Friday following the 1 or 2 week payroll time periods. For example, on April 26, 2024, for the time period from April 7th to April 20th. That would mean that the incurred period, April 7th to April 20th, and the pay date of April 26th are all in the same month. The payroll team produces the payroll register and paychecks by April 26, 2024, and provides the information to the general ledger accountant, who in turn records the wages, salaries, withholdings, and net pay in the general ledger on or before April 26, 2024. But what about the next payroll period, which begins on April 21st? The next payroll spans 2 months. The payroll period from April 21st to May 4th is paid on May 10th. What should you do before you close the general ledger for April? The payroll expenses for April 21st to April 30th, which are 7 workdays, belong into the April financial statements. But the payroll process won't be completed until after the end of the payroll period of May 4th. We have at least 2 options. Option 1 is that the accounting team waits until the payroll reports are available, typically about 2 days before the pay date, and then receives the payroll register to figure out how much of the payroll is for April. Option 2 would consist of you estimating the amount based on the prior payroll, if the next payroll period is expected to be about the same amount as the prior payroll period. So how exactly would you do that? For instance, if the prior payroll period had gross wages of $24,000 for 10 workdays, you would accrue for April 21st to April 30th, 2024, $16,800 for 7 workdays. And the entry to accrue for the April wages would be a debit to salaries expense and a credit to salaries payable for $16,800. Most accountants use the auto reverse function in accounting programs. That means that when you record the accrued expense, like in this example for $16,800, you flag the entry as auto-reversing, and the system will enter the exact opposite of your entry at the beginning of the next month. Why? Well, when the payroll reports are generated on or around May 10th, the accountant enters the payroll amounts into the general ledger. If we did not reverse the accrual in the next month, we would have essentially recorded too much in expenses. A related topic to accrued salaries or wages is accrued payroll taxes. Payroll taxes are not legally owed until the salaries are paid. However, businesses want to match revenue and expenses in the appropriate period and accrue the employer's payroll taxes, even though the tax liabilities are technically not yet due. So let's calculate the accrued payroll taxes, assuming that the accrued payroll is $16,800. We calculate the various payroll taxes, such as Social Security, Medicare tax, FUTA, and SUTA, for a total of $2,293.20. To record the accrued payroll taxes, we debit the payroll tax expense for $2,293.20 and credit Social Security tax payable for $1,041.60, credit Medicare tax payable for $243.60, credit FUTA tax payable for $100.80, and credit SUTA tax payable for $907.20. Let's look at another example. Here's another example for accrued interest. In this example, the company takes out a loan of $100,000 on January 1st with an annual interest of 6%. The interest is payable semi-annually on June 30th and December 31st. By January 31st, the company has incurred 1 month worth of interest, but it hasn't made any payments yet. To accurately reflect this expense in their financial statements, the company needs to accrue for the interest. The annual interest for a $100,000 loan at 6% would be $6,000, and divided by 12 gives us the monthly interest. We would record the interest expense accrual by debiting the interest expense account and credit the interest payable account for $500. In addition to accrued salaries and wages and payroll taxes, there are many different expenses that accountants accrue for. Our textbook had an example of $20 accrued interest expense. However, most companies have a materiality threshold for journal entries, for instance, $1,000. After all, accounts typically work with very tight deadlines during the month close, and it would not make sense to spend time on accruing for $20 expenses. In most organizations, the average cost of recording an easy journal entry is $40. That includes the time to set up the template, enter or upload the entry into the accounting system, review it, post it, and have a manager sign off on it. That means that with some exceptions, the company will only accrue for an expense if it exceeds the materiality threshold. I hope you enjoyed this video about accrued expenses and learned why and how accountants record accrued expenses.